Welcome back to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Inside ETFs in Hollywood, Florida. And joining me for this segment, we have Simeon Hyman. He is the Global Investment Strategist over at ProShares. We're going to get his small and mid-cap stocks investment outlook for 2020. Simeon, it's great to have you back with us.
Thanks for having me.
On Trade Talks, and we're certainly in the midst of a long economic suspension. Are you still optimistic going through 2020?
Yeah, there are a couple of things. First, remember, 2019 was a great year, but remember that fourth quarter of 2018? So, end points and beginning points are always tricky. If you go 5 quarters, not so great. Second, we have very low interest rates. That supports valuation multiples, so they're not so extremely high. And third, there is an opportunity for some earnings growth, particularly as we've sort of now anniversaried the tax cut that briefly popped up margins for the S&P 500.
Right, and I also think the question is, with valuations where they are, and we're in the thick of earnings season right now, you have to have a really good quarter to justify those valuations. So earnings growth is really going to be key as we go through these quarterly reports.
That's absolutely right. One of the things that we focus on is looking for quality stocks. And as an example, if you look at companies that have consistently grown their dividends, they grew their earnings because that's the only way you can grow your dividends. But as an example, last year they grew their earnings every quarter, whereas the S&P 500 as a whole actually started to see earnings growth decline. So some sort of metrics for stability in earnings and cash flow is important late in this cycle.
Let's talk about opportunity in the small mid-cap space.
So if we look at relative valuations, meaning, and we like price to book, it's a good sort of long-term proxy for earnings power, we have seen both small and mid-cap stocks decline from parity against the S&P 500 to now trading at around 60 cents on the dollar. So they're at a 40% discount. And that's pretty big. I mean, we know this anecdotally. You watch the tape, you know that large caps and even mega caps have been running the show. So there absolutely is a valuation opportunity there.
Is it as simple as investing in plain vanilla indices in mid and small cap stocks, or is there a different approach that you should be taking?
Listen, you could, okay? So we said that they're at about a 40% discount. The average is 20 to 25. So you could take that approach, but the challenge with that is as you go down in cap, margins get slimmer, returns on equity and assets get slimmer, leverage gets higher. So again, this quality story, a proxy for us is dividend growth, but if you follow that quality story, companies that have higher margins, higher return on equity, less leverage, dividend growers in that space are actually trading at almost the same valuation as the plain vanilla S&P 400 and Russell 2000, so you can capture the valuation story, but in a higher quality way, which is, we think, a prudent way to go about that in 2020.
Let's talk a little bit more macro. Certainly, we're only 4 weeks into the year. It has been a pretty aggressive news cycle, to say the least, from a geopolitical perspective, and of course what we're dealing with the coronavirus. What's your volatility outlook going for 2020? Do you think it'll be a little bit more than we saw in 2019, particularly as we get into the U.S. elections?
Well, look, you can't account for the black swans. You can't account for viruses and those things. I think there's a couple of things that suggest that at least the economy will stay on this sort of muted growth path. And it's a Goldilocks. And where do we think that Goldilocks is coming from? It comes from the combination of a strong consumer and service sector, but a weak manufacturing. Why are wages not going up? Well, they went up 20 and 30 years ago because if you were flipping hamburgers, at some point in the cycle, you got a job on an assembly line for like 4 or 5 times as much money. That's just not happening right now. Wage growth's not happening, inflation's not happening, but the consumer sector is so strong. Here we are at 2.5% GDP growth. That can be sustained for a while longer without overheating the economy. As an example, the Fed's going to be at bay. Right. So that should be a factor keeping things a little bit on the stable front. And look, I think we all suspect that to the extent the administration can get little pieces of good news feeding towards us towards the election, we've already seen some of that on the trade side. That may be another positive catalyst. But black swans, who knows?
All right, Simeon, thanks so much as always for joining us. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.